Good morning, everyone. It's Jared here from the Alpha Capital Group to do a weekly roundup after the volatility that has ensued this week. So I suppose the big talking points this week from a fundamental side, I suppose back into the markets, irrespective of just if we park what's happening with Russia-Ukraine to the side for the moment, which we'll be discussing in a few minutes, was one, the FOMC or the Federal Open Market Committee, which is the US Central Bank on Wednesday evening. And we had the Bank of England interest rate decision yesterday. Now, if we talk about the Fed first and foremost, the Fed has opted to begin its rate hiking cycle and increased the interest rates to 0.25% from pre-existing levels from what would have happened beforehand. So we got that 0.25% hike on Wednesday, helping to, I suppose, start this new cycle of rate hikes. Now, I suppose broadly speaking, we did see a little bit of a snap initial reaction in the markets, particularly the dollar, particularly the indices as well on Wednesday evening. However, as soon as Jerome Powell began speaking on Wednesday evening at 6:30 p.m., the markets, despite the hawkish nature which would be implied with a rate increase in the interest rates, the markets actually continued to push higher, made a very, very sharp V-shaped recovery, and actually continued moving higher. Now we can actually see that in the shorter term price action here. This is where we were kind of Wednesday evening on the decision. We saw that sell-off price action made a very, very sharp U-shaped recovery, as we can see here on the S&Ps, and we actually continued to move higher through the course of the session into the session close. And more broadly speaking, since then, the price action has continued to remain fairly consistent. We saw that across the board. We're seeing it in the NASDAQ, we saw it in the Dow Jones, and we actually also saw it in the DXY as well, which temporarily did make initial snapback to the upside on Wednesday, but since then the dollar has weakened somewhat as the indices are rallying. So we're seeing that risk on narrative into the close of the week, and markets very much kind of continuing stronger. Now, meanwhile, in the Bank of England, when we look at the Bank of England, we can also see that yesterday saw the Bank of England continue to raise rates again for the third successive occasion, which saw another 0.25% increase. Now, the hike yesterday was fairly dovish in nature. And the reason why that was the case is because market expectations was that some of the members were going to be looking for a 0.5 increase rather than just a 0.25 increase. However, that didn't prove to be the case. Instead of maybe having 6 members voting 0.25 and maybe 2 or 3 voting 0.5, we actually saw no members voting for a 0.5 increase, and we saw 8 of the 9 members voting for 0.25%. Cunliffe was the exception, who actually opted to keep rates unchanged, actually. So you could see that there was a bit of a narrative change by the Bank of England, that rather than going for more successive hikes or illustrating that momentum in the future, it actually looks like even for the next interest rate decision, the Bank of England may actually hold fire. So as a direct consequence, we saw the pound weaken significantly. If you look at the pound against the Aussie or the pound against the Kiwi, we saw those movements quite hefty to the downside. We saw that weaker pound, we saw the weaker gilts, and we saw the FTSE tick up marginally. Now, what I'm actually going to do is I'm actually going to just show you that very, very quickly. And we can even represent the movement on the pound Aussie since yesterday. So the pound Aussie movement yesterday saw this massive decline very, very quickly, and the price action sold off a mere 200 points over the course of the day. So we saw that massive sell-off in the pound Aussie, as we said, pound Kiwi, and even across the board in the pound pairs, you'll see massive volatility. So very, very much a kind of a changing narrative across the globe with these central banks. We're seeing many central banks now raising rates. So I suppose now it's going to be, I suppose, all eyes on the data now over the next kind of 6-8 weeks, because the next meetings now with these central banks is until May. So they obviously meet 8 times a year. So it'll be an interesting viewpoint where we stand come May, particularly off the back front of this sustained inflation figures, inflation data, lower than expected growth, which was both decreased across the board, with the Fed reducing their growth forecast on Wednesday from 4% to 2.8%, So we have to take all these things into consideration collectively. Now, broadly speaking, as we look at the markets this week, yes, the Russia-Ukraine narrative is going to continue to play out. Russia did confirm yesterday that they did make a $117 million bond payment. However, bondholders are saying that that funds is yet to be received. So this could add a little bit of a default risk in the markets associated with rubles as bonds get marked lower on the default rating system. So worth keeping an eye on that into the weekend to see, because if it turns out that those payments have not been received or have not been validated, we could see a little bit of volatility in the markets as well. So I suppose broadly speaking, if we factor in the price action in the markets, we can see that the dollar had created that top formation at 99 or just slightly above it, between 99 and 99.5 in the index. We have seen that weaker dollar over the last few days, but we are seeing this retest again of this 97.75 level. So this area that we've alluded to over the last number of weeks, the price action had broke through. We have popped up for the second one, and now we're finding support here again. So short-term support into the weekend is holding the DXY around this 97.75, 98 level. We can see that that's been supported quite nicely. So if there is potential for the upside, look for the third drive into these highs again at 99, 99.50 area. If not, we would need to see the price action break through these levels to initiate a more wider bearish outlook for the DXY in the short term and the dollar more broadly speaking. So with that as well, we'll obviously look at the indices. I suppose first and foremost here, as we look at the S&Ps, we can see that the S&Ps now is trading back into those weekly highs noted last week around 4,400. We saw that continue to rally right through from the beginning of the week. The price action obviously did have that choppy volatility on Wednesday evening, but since then we have finished the week out fairly high and is testing this 4,400 level again. So I suppose in the shorter term, all eyes would be to determine to see how does the price action react in the short term around this 4,400 level. And if we see a potential breakthrough, should I say, then we're looking for the price action to potentially kick on. So I suppose worth keeping an eye on the weekly closes to see where does the S&P close in a broader consensus. We've also got this broader bearish trend structure continue to play out. We've got the broader successive lows and highs continue to play out with what we're seeing now as a consolidationary factor. Now, I suppose the one caveat thing that I would also like to mention here is on the indices. If you look at the stock markets, broadly speaking, since the Russia-Ukraine invasion on the 24th of February, we actually can see here that the stock markets are actually trading in a sideways / higher scenario. So all the bearish momentum associated with the Russia invasion of Ukraine actually hasn't really played out too much in terms of the US markets, because we have seen the S&P and the NASDAQ and the Dow Jones remain fairly strong overall. Now, of course, the NASDAQ is the least strong of the three, because obviously it's affected by the tech stocks, the growth stocks, which is a direct offset of the inflation outlook. So I suppose that the caveat there will be to factor the NASDAQ in slightly differently. But if we look at the S&P, the broader market index, we can actually see that the index has performed quite well since the Russia-Ukraine invasion. So we're keeping that in the back of your mind as well. Now, if we look at the NASDAQ very, very quickly, the NASDAQ too has continued to move stronger. This 13,000 level that we alluded to at the beginning of the week has held up pretty firm. The price action actually has continued moving higher, and we have since broken back above this shorter term 14,000 level. So if we look at the price action now, we can see that this consecutive lower high scenario is playing out again. We're seeing the price action into the close of the week rally a mere 1,000 points, and is now consolidating, as we said, around this 14,000 level, just underneath the 200 EMA on the 4-hourly chart. So I suppose as a market preview for next week, I think the break or bounce scenario is going to occur around this level here at 14,000. We saw a lot of price action over recent weeks and months. So let's see how the price action reacts. If we're breaking through this level, then I think for the short-term traders, you could potentially see that bat of interest to the upside. If not, we could very easily see the price action roll over again. So I suppose watching the nearer term viewpoints as well will be interesting, particularly for those trading on the shorter parameters. Again, you can see that 14,000 has been clung on to fairly tight as a key price action level, both as support and resistance. Last but not least is the Dow Jones. So this is something I've been kind of looking at personally, was the fact that the price action on Wednesday, we got this massive spike again. We had a massive 300-point sell-off, followed by a mere 500-point rally. We paused initially at 34,000. We have since broken through yesterday, and we've continued to push higher into the 61.8 Fibonacci retracement. So numerical sequencing being factored into consideration here, and we are seeing the price action now stall out under the 61.8. So I suppose logically now, if you're looking for this bullish momentum to continue playing out, we would be looking for these wicks to effectively be engulfed and the price action to continue pushing higher to maybe 34,750, 34,800 level up here. If not, well, then there is the possibility for the price action to start trending lower again, repeating this current bearish trend structure where we have these lower low, lower high scenarios that we've obviously illustrated over the past number of weeks in previous videos. Now, the second caveat here is something that we're actually going to focus on, which is quite new, which is the US 10-year yield. Now, broadly speaking, the US 10-year yield, anything above kind of 2.1% is generally seen to be quite bearish for the markets, and as a direct consequence, seems to be quite recessionary. Now, if we look at the price action, yes, over the last number of years, the price action has continued to trend lower with lower yields. However, we saw that massive impulse last year. We saw the massive pullbacks, and we're getting this fairly strong bullish trend since the back end of 2020 with the price action now, as of this week, effectively taking out this 2% level. So if we look at the shorter term or shorter run price action levels, we can see here that the yields has topped out initially at around about 2.3%, 2.23%, apologies, just under 2.25. And we are seeing a little bit of sell-off in the last couple of days. So the likelihood is the 10-year will probably try and make a little bit of a run lower back to this 2.05% level, as we've alluded to here. So we're keeping an eye on that as well over the next few days. So the yields is a little bit more on the investment grade side for those of you who are not so much traders, but more investors. So worth keeping an eye on the 10-year as well, as a side note, because the reason why I'm looking at the 10-year is because the 10-year seems to affect the gold hedge quite a bit. So if the 10-year yield generally trends higher, you tend to see the gold getting hit a little bit, and then vice versa. As the 10-year yield moves lower, you tend to see a little bit of a movement in strength in the gold market. So if we look at the correlations, we can actually see that as the 10-year has been picking up strength, gold has actually been moving lower. And over the last few days, as the 10-year yield now has been kind of leveled out and it's kind of plateaued back to this 2.15 level and potentially back to this 2.1%, we're actually seeing the gold prices just move marginally higher. So again, seeing how this correlation works in the markets. Now, if we look at gold more broadly speaking, we can see that there is this massive kind of inverted V-shaped sell-off. So we did get to these highs. Price action last week, as we mentioned, this 1916 level was key. We did eventually break through it, and we had a shorter term break and retest structure on the 1 hour. The price action has continued higher and did continue all the way back into this 1900 level. So worth keeping an eye on gold short term, because we are mid-range. We are holding this 1900 level after this break and retest of 1960, and the price action now is kind of in a consolidationary kind of waving sideways state between 1900 and 1950 at the moment into the weekend. So we're keeping an eye on that, particularly as well. Any bearish fundamentals, particularly with Russia, Ukraine, could potentially spike gold higher as well. So we're keeping an eye on that in the back end. Last but not least is the oil prices. So yesterday, the oil prices did get a massive bounce, particularly after that halt at the 50 MA. So this area that we looked at on previous weeks of the gap close at 92.50 approximately didn't quite make it. We did mention over the last number of weeks, we thought that it might get there. And it was something I was watching particularly closely. But you can see how the price action bottomed out just under 94. We saw a massive recovery back into this 105, 106 level. And now we are trending higher again. So whether this area at 92 into 94, this gap gets filled in the end, is still kind of highly doubtful at the moment, because we did see that massive recovery in the oil prices there over the last 24, 36 hours. But again, all eyes will be on the oil prices into the weekly close to see, do we sustain ourselves back above this 100 level, or does the price action take another tumble? We are seeing massive 6, 7, 8% moves on an intraday level on the oil prices. We saw, I think on Tuesday and Wednesday, an 8% move, followed by yesterday another mere 6.5% move to the upside. So it is important to I suppose, take these increases with some trepidation, because the markets are significantly volatile and they are continuing to play out that way. So 6.3% sell-off on Monday, followed by another 7% sell-off on Tuesday, followed by a mere 9% recovery yesterday. So we are finishing the week down as of where we stand at the moment, but the gains yesterday has pared back some of those earlier weekly losses as well. All right. So as we said, folks, we'll be back on Monday for another preview next week. It was a massively volatile week with many central banks giving their forecasts, giving their outlooks this week. And of course, next week, we have a new week as well. So we have to be cognitive of the weekend movements over the price action. So we will be taking a look at the markets on Monday. All right. Have a great weekend, everyone, and we will see you all next week.